In this video, we're going to go over one of the most fundamental structures in this entire trading system, and it's called a fair value gap or low volume node. It's used across different time frames, and it has a pretty predictable and repeatable behavior. We're going to talk about how to identify it and the implications of it existing on the chart and how we should start trading around it. When I talk about low volume nodes and fair value gaps, I'm essentially using them in an interchangeable way, even though they are a little bit different. I like the term low volume node because I think it's a little bit more descriptive. What it really means is an area where the price has not stayed very long and there's not very much congestion or trading activity there. It's an area that price has moved rapidly away from. We're going to go over how to identify it in a second, but the implications of the price moving rapidly away from a given location is that there are trap traders in the other side of that location, and we can use this area as a reference point for entering whether it's valid or invalid. The idea of fair value gap has to do with how the price is extending. So we see down here that there's the volume indicator, and we can see that there's like a collection of volume here where if we just mark this like this, there's congestion here. For example, congestion here, there's some overlapping bars here, there's some overlapping bars there. But what we see here is that the price moves from the open to the close and there's no overlapping bars in that. So you can think that there's a lot of trading activity that's happened in here and the price shoots up from there and shoots up from there, and then everybody who has entered the market in this area is now trapped. How do we identify this? We can look at bars that have a open and a close in a direction with no overlap, as I've marked here. Or another way that we can identify it is if we use a fixed range volume profile indicator. We can see these areas where there's almost no congestion right there, and you can notice that that's the same structure on the actual price right here. Either way, it's an area where the price has moved rapidly away from that point. These points are good reference locations. We can use them as an area that the price is likely to respond to, and then when it doesn't respond to that, we have what's known as an inverted fair value gap or an inverted low volume node. And those are also opportunity areas that we use in our trading system. If you think about what's happened here, the price is congested here, it shoots down rapidly there, and then there's like a gap in the price from here to here where it just travels through there. That implies there's an opportunity. If we go back to this other chart, for example, you can see that the market shoots up here, there's no congestion there, and then when the market does come down to that, there's a lot of activity. The market bounces there, and this one particularly doesn't work in this case. We have other things that we use to screen for these trades, but we do see that there's a very clear response to this area, and that tells us that this structure is valid. These are used as both reference locations and then also an indication of trend health. So with this big push up here, as long as the market is above this location, that means that the trend is healthy, and we can see that as the market starts to probe below that, once the attempts to buy that break, that's actually a reversal and the market goes much further down below that. This is a fluid structure, so we can see that as the market comes down below that, this actually becomes an area of resistance later. We can see there's another one here on the downside of this particular event where the market pushes through this. This is a gap from here to here. It's just all red candles with not very many overlapping bars. We see that the market responds to that, and then when it comes above that, it attempts to hold that again. So it's a fluid area of reference that we use to indicate not only an area where we can enter a trend that's healthy, but also an identification of an area when a trend has reversed or is showing weakness. Another example just from this chart that you can see right away is here's a fair value gap, aka LVN. And once the market goes below this, this again becomes an attempt to sell off of that. And then once the market clears above that, it trends up for 20 or 30 minutes here after that. This might not look like a big movement, but in intraday futures trading, this is, I don't know, how many points is that? 50, 60 points? That's enough to make quite a lot of money off of if you're trading in the direction of that. So if we're using this as a trend invalidation screen, once this has broken, we're now trading in the down direction. Once this is broken to the upside, after this, we're trading in the up direction there. These areas create residual pressure. So when I say they create residual pressure, you can see here, there's a big gap there. The market actually, I drew that slightly incorrect here. From here to here, there's no overlap in this. And you can see that as long as that is open, the overall trend, at least with reference to this, is down. So every pullback here is sellable to the downside. There's one here as well. And you see that as long as it's under that, there's residual pressure down. And when the market goes above that, it's now bouncing between this gap here and this gap here for some time. So you can think of it like in this case, all of this congestion area here are people who have entered the trade and they're in positions. Once the market accelerates, and even up here, and once the market accelerates down from there, they're stuck and they have to keep selling their positions. So if the market bounces up, they're likely to try to get out at resistance, and that's an opportunity area with different other structures we can start selling in reference to those. And as long as this doesn't clear this, everybody up here is going to have to liquidate their positions. There are some trend excess structures that we will talk about in different videos that might indicate a reversal, but as long as this gap here is open, the market is going down. One other thing to note is that just because the gap closes doesn't mean that this is immediately a reversal. It just means that there's an opportunity for these traders to get out. So the residual pressure is somewhat weak. However, everybody who is traded in this area up here is still trapped and looking to get out of their position. And we can see that now that we're in this area, the market does pull back considerably from there. These are viable on a number of different time frames. I usually use them in the 3-minute, 1-minute, and 5-minute time frames. They're a little bit less useful on the 15-second, although we do use them to indicate direction there with open gaps, et cetera, et cetera. But the bigger the time frame, the more powerful they are. So we have a 5-minute gap here, and then this lasts for the whole day until the open up here. 1 minute is a reference to the intermediate or immediate trend on a shorter term time frame, but is still a very useful area of reference. We can also use them as an indication that the trend is weakening. So here we have a gap here, and when I say area of useful reference, you can see that there's a gap here. The market bounces there, comes up to the high, and then it goes below. There are trap traders here. As you can see, it's a very easy opportunity area, but the market doesn't continue much higher off of that. And then once we start looking for, or once a failure starts occurring of that level, there are deepening pullbacks. So we can use them as an indication that the current and most immediate trend is no longer intact. That doesn't mean it's reversed. It just means that now the market dynamic has shifted. And on the same chart, we can see that once they're invalidated, that means the market dynamic has shifted. So this is broken. There's an attempt to hold this, and once that continues to go down below that, the market trends down for some time. Just continues trending down. I've not looked at this one, but you can see that that is an indication that this is broken, and we should really, in this case, stop buying this. There's also one here, and it's the same thing. We can use this as a reference location that once this gap has broken, we're no longer in a uptrend, and so we're no longer executing uptrend strategies. I hope this was helpful. Remember, this is an overview of the structures of the system we use. These are just objects, things that we can base trades around. And the actual trading system is a collection of reference to these various different objects that we will go over on how to implement as we get further along this development process. Thanks for watching. Again, I hope this was helpful. Please like, comment, subscribe, do all the typical YouTube stuff, and stick around and watch the next videos. Thank you very much.